Hey traders, welcome back to another video. So in my previous video, the title was Understanding the Probability Game and Mastering Bet Sizes and Think Like a Professional Poker Player. If you have not watched the video, go watch it before you watch this video. So there's one comment by Brian Ang. He said that, I think you have to clarify the part about sizing in when you have losing streak because it means a winning streak is about to come. It's not optimal because mathematically having a losing streak that lasts forever is not impossible even when you have a strategy with positive expectancy. But I understand where you're coming from. Given that you have a positive expectancy strategy, your outcome should be positive in a series of trades. However, no strategy can predict the outcome of your next trade, which is correct. What he says is actually correct. And one reply by user PO5YT say, yes, same, I can't also understand the concept of dynamic risk, where wins and losses are distributed randomly. And this remind me, again, what Brian Ang and this user PO5 say were both correct. Wins and losses are always distributed randomly. The fact that, let's say today you have 50% win rate, you can be losing 5 trades in a row before the next win. You could be losing 10, 15, 20 trades in a row before experiencing a series of winners. But the fact is, an edge technically means you already have a system that is proven to be profitable over the long term. No one, like Brian said, no one can ever predict the outcome of your following trade. But if you put it on a large sample size, the results are predictable. And that's why in the video, the title says think like a professional player. I've spoken with some 7-8 figures trader. Some of them are trading at the professional trading floor, which means they're institutional trader. They always emphasize on one thing, which is linear risk per trade. So let's not talk about traders in general. Let's talk about the professional poker player. And that's also why in my previous video, the title was Think Like a Professional Poker Player. On some of the hands, they fold. On some of the hands, they bet small. Or they just don't raise. They just watch and monitor. On some of the hands, they raise. Alright? Why do they do that? If, let's say, having a static risk per trade is the holy grail to trading success, just because you think the winners and the losers are distributed randomly, that means you don't actually have an edge and you probably don't know what you're doing. Just again, go back to the professional poker player. Why do you think some of the hands, they start betting bigger and bigger, they start raising? It's because the moment when the dealer open a new card, they realize that, hey, in terms of probability, it's leaning or is favoring me. And that's how they gauge the idea of, hey, on this hand, I should be betting a little bit bigger. On this hand, I should be betting smaller. It's not because they're genius. It's simply because of math. The same thing goes to trading. Why some of the setups in my trade club, I always categorize them as A+ setup, as A setup, as B setup. That's because on certain play, you just know the odds are not into your favor. For example, if let's say today you're catching falling knife, the market is on a heavy uptrend, and you're trying to catch the top. Let's say Bitcoin is pushing all-time high, just for example, and you're trying to catch a falling knife here and say that I believe it will reverse heavily for $5,000. From 65k is going to drop back to 60k. This thesis itself, do you think is convincing? Probably not. Do you have enough evidence that tells you this trade idea has a higher probability of success, which means the odds is favoring you? No. Why? The probability is low, the quality is low, because the only confirmation or the only evidence that you have is your intuition, and intuition itself is not reliable. And that's why inside the video I say that when I have a series of loser, I roughly know that the winner is about to come, and that's when I start sizing in. And again, sizing in doesn't mean I go in 5%, 10% risk per trade. It could be as simple as psychologically, mathematically, from my edge, from my statistics, I know, let's say for the past 3 to 4 years, my worst losing streaks is 8 losses in a row. And for the past 3 to 4 years, this max drawdown data has been respected very well. So let me ask you one thing. If let's say you already have 4 to 5 years of data, clearly telling you your worst possible drawdown per year is 8 losses in a row. What's the likelihood of price exceeding 8 losses in a row this year? It's low or is lower. Why? Because from the statistic, I know the chances of me losing 8 trades in a row is pretty slim. Beyond 8 losses in a row is even slimmer. And that's why inside the video, I say that just think like a professional poker player. Trading, we are like a poker player as well. The main reason why majority of the traders lose money is because they don't understand the game of math and probability. Alright? When I say I'm going to start sizing in after a series of losses, what are some of the evidence that I had in order for me to start sizing up? First thing, I know what's the worst possible scenario. How do I know? From the past statistics. Second thing, if you have an edge, you clearly know that the losses will not be forever. Because what Brian said was, having a losing streak that lasts forever is not impossible, even if you have a strategy with positive expectancy. If you have a losses that last forever, that means you don't have a positive edge. You don't have a positive expectancy strategy. Alright? If you have a strategy with positive expectancy, the losses will never last forever. The fact that the losses last forever, there are two scenarios. First thing, you don't stick to your strategy or you don't even have a strategy. Second scenario is you're getting emotional. And these are two main reasons why traders lose money over the long term. Because an edge is just a set of rules that you apply into the financial market that is proven to generate you money over the long term. That's an edge. So if sometimes you get emotional, you lose half your account, or sometimes you get emotional, from the probability sequence, you are, let's say, the probability tells you you're only going to lose 5 trades, then you got the next 10 are coming in. But you get emotional, after 5 losses, you revenge trade, that means you don't really have an edge anymore. An edge means that the system is proven to be profitable over the long term. Remember, if you don't have a system or if you're not proven to be profitable, how do you know? From your statistics. Simple. Then you don't even have an edge. If you have a strategy with positive expectancy, it is impossible that losses will last forever. Even you have a really ugly losing streak, in between there will be something that could be possibly adjusted or fine-tuned to fit the market condition, to fit the volatility. That's what I'm trying to say. And again, no strategy can predict the outcome of your next trade, of course. And that's why in the video I said that after a series of losses, I have the idea, I roughly know based on the math, the winner is about to come. But do I know the following trades will definitely be a winner? I don't know. Maybe it's the following one. Maybe it's next one. So after I know the winner is about to arrive by either next trade or the following trade or the following trade, so what do? I clearly know my game plan. Now I know my game plan. Now I know that, hey, if from the math or from statistics, it tells me that, hey, in the following few trades, I'm about to have a winner. How do I know? Again, based on my statistics, because my worst losses in a row, my max drawdown has been proven to be, example, 8 trades. If I'm currently losing 8 trades, and I clearly know that all of the 8 losses are setups that's within my game plan, of course, I know the winner is about to come. Again, it's math. It's statistics. If you have not done intensive data collection, or if you've not done intensive journaling and reviewing, of course you will always feel like, oh, I need to treat all of the trade the same way. I risk 1% risk over all of my setup. If you go to any of the elite trader or any of the professional poker player, they will never tell you this. And in fact, if you today you have a series of losses and you go size down, that's what the majority like to do, because of course they will always say, find an excuse, which is because after a series of losses I realized that I might be a little bit emotional, and that's why they start sizing down. It's not wrong, but the fact that you're sizing down because you're concerned that your emotions are about to take over, that means you again probably don't have an edge, because you're getting emotional. Why are you getting emotional? The fact that you're getting emotional is because you don't trust your system, or you don't have faith in your system. You don't have faith in the math business, in the game. So if you study some of the elite trader, like one of the example I love studying is Lance Brightstein. All right, Lance Brightstein is one of the proprietary trader or elite trader on S&P Capital New York. He also emphasized on the importance of linear risk per trade system. Linear risk per trade technically means you grade the quality of your setup. Let's say for me, I have different setup. I got TPF, I got BNR, I got rollover / exhaustion, and I got a flag. And I know that when I have a combo, when I see a flag or I see a BNR combining with TPF, when both setups combine together, they give me the highest chance of success. So when I see this pattern appear, this setup appear, this combo appear, of course I will go a little bit heavier, because if I don't do that, when am I supposed to make money? Some of the people, if you hear this, you might think, hey, but you will never know if it's going to be a winner or not, because winner and loser are distributed randomly. But from the math, from my statistics, from my experience, the chance of success is at least higher. If the chance of success is higher than 50%, it's worth taking a little more risk. I hope all of you, if you're watching this, you understand where I'm coming from. And you may not understand what I'm trying to explain if you are fairly new to the market, because you don't even know how to distinguish what's a high quality setup versus what's a low quality setup. And that's why you think, oh, having infinite losses is not impossible. Yes, of course. But if you have a strategy, again, with a positive expectancy or a positive edge, it will never happen. The fact that it happens is because something's wrong. Either you are not really applying the strategy in the right condition, if you're pushing too hard, or you are getting emotional. You rent trade, you take losses that are not supposed to be on the stats, and that's why you're seeing such a scenario. And also, to this user, you cannot understand the concept of dynamic risk. For any of the new trader, or if you're currently struggling to achieve consistency, do not bother about scaling into your winner. Do not bother about having a dynamic risk system, or what I call a linear risk per trade system, because you don't even know how to distinguish or categorize what's an A setup, what's a B setup. If you don't have the experience, if you don't have enough sample size to tell you, hey, based on my data, this is A, this is B, or this combo is A, then of course you shouldn't do it. Because if, let's say, you don't even know how to distinguish the A and the B setup, and you start having a linear risk per trade system, you are technically just guessing. Oh, this one looks good, I'll size up. Or this one looks bad, I'll size down. No, all of it have to be according to your stats. And that's what I'm trying to explain here in this video. Because I don't want any of you watch my previous video and you're currently running on losing streaks and you start going really heavy and you say, hey, Nyo say that when I'm on a losing streak, I need to size in big. No, you need to do it professionally. You need to really know where I'm coming from and why do I know the mathematical game. All right, I'll give you one example. This year, it was around March or April, I had about 5 losses in a row, and based on the setup itself, the worst losing streaks I have, the max drawdown was only about 4 to 5. So when I took 5 losses in a row on that specific pattern, that specific setup, the next trade, I know that mathematically is about to be a winner. Of course, I don't know if that one will be a winner, but what I did was I sized up a little bit. Let's say my usual risk is 1.2%. On that following trade, I risk about 1.5, and when I see market proves me correct, I start sizing in. And guess what? That trade turned out to be really a winner. Am I a market genius? Why do I know that trade is about to be a winner? No one knows. But from math standpoint, I roughly know. And as long as it's above 50% chance, it's above 60-70% chance, I know I'm doing the right thing by risking just a tiny bit more. And when market proves it correct, I scale into the position. And guess what? On that trade itself, I made about $30,000+ and recovered all my losses, almost doubled the amount, and I'm back positive. And it goes back to another thing by I think it was by Brian. Let me just refresh it a little bit. I think Brian also not sure why I cannot find it. Yeah, but again, I hope all of you really understand where I'm coming from, and I'm just trying to tell all of you, just learn how to master the mathematic game. Trading is a lot about understanding probability and really have experience to tell what's an A setup, what's a B setup. You know, once you start having enough stats and you start categorizing them, you realize, hey, this is really a math game. And by then, you won't be emotional anymore. The fact that you're emotional again is because you don't have an edge. So that's it for the video. If you like it, please don't forget to like, share, and subscribe. And I'll talk to you in the next video. Bye-bye.